have now this nice build up of liquidity, and we've got our nice higher time frame liquidity points target down below. So it's a nice little bit of information around inducement. When we actually look at this back on EU again, just where we were looking on a minute ago, we can see it's gone to a nice time frame. So let's have a look. Let's have a look here. So this level here is less likely to play than this level up above here, because this level has significant liquidity for the market to take out. We have, a high amount of liquidity for the market to take. We have a protected high because this high takes liquidity inside of here. Price comes up. Do a little diagram on this. So we have high, which gets swept. Have this liquidity, and then we have a bunch of just shit going on here. Price is inclined to this level due to the liquidity that exists here. Price subsequently builds liquidity to target, and once price delivers to the level, it continues down and eventually takes out its next point, which is the low. This level leaves behind another zone here. Why is this a trap? So when you study this, there is not any significant liquidity. No liquidity. It's simply a push down. Nothing in here. So we can expect this to be taken. So then continue down. So this high, since there is no liquidity that exists in here, this high is the liquidity. So we would be looking at this zone here. Here we go. We have our fake breaker structure, fake chock, as we were talking about earlier. That's sitting in there, hiding. There you go. It's nice fake bars. It's fake push down, getting traders involved off of this big supply. Up time frame a little bit. There you go. Getting them final traders involved off of this level here. They get liquidated. Price takes the liquidity and eventually continues down and delivers off of this level. There you go. Same thing happens again. This level here does not have a huge amount of liquidity that exists here. You may argue that level here is valid liquidity. However, for inducement, we are more inclined to immediate inducement. So what does the word immediate mean? Well, we want the liquidity to be immediate to the level. So it needs to be close by. It needs to be very relative. So, for example, for example, this level here, the liquidity is immediate because it's very close by. So as soon as the liquidity is taken, the market can mitigate its level and continue down. Whereas within here, the liquidity is very far away. There's no immediate level. Whereas when you then look at this high as being and refine this level, this refined candle here which has this immediate liquidity here. So when price comes up, it can mitigate and take liquidity. We have that aggressive reaction for price to then continue down to its next liquidity point. Beautiful. Entries as well. You know, there's other entries that you could get involved in. Side of here using literally the same theory we've just been talking about with inducement and algo structure. The market builds liquidity. Builds liquidity on both sides. It's always important to remember. Builds liquidity on both sides, takes out one side, and then continues to the other. You know, we take out one point, we take it out here, we continue to take out more. We build liquidity, and we continue to take it out. We take liquidity, we build liquidity. You know, it gets swept here, comes back to mitigate, and we take it all out. Essentially, as a result, get down to our desired level. So it's a nice little touch on inducement. Obviously, we're going to be seeing this a lot throughout this recording. You know, a lot of our trades, well, every single trade is going to use liquidity. Inducement, not every single one's going to use inducement, but 90% of them, you know, inducement, algo structure. Essentially, you know, this is the most highly probable ways to get, you know, a good pricing, a good fill, good entry in the market. So yeah, that's a nice little touch on there. Next, we're going to be talking about internal range liquidity, and then we're going to get more into sort of early manipulation types, such as the fake break structure, fake change character, which is the same thing, market maker models, etc. We're going to touch a little bit on how to use fixed range volume tool to sort of identify which liquidity points have more than others. And yeah, always remember, guys, price does not need structure to move. Price needs liquidity to move. The algorithm does not need highs and lows. The algorithm does not move the market with intention of forming highs and lows. It moves the market from one liquidity point to the next. It has to move up and down. You know, the market cannot move like this. It has to move like this. It has to go up and down. It can't move just in a straight line. Why? Because if the market's moved in a straight line, what would incline anyone to take a sell? There's nothing to incentivize people to take sells. We need movement like this, so the market can reprice to fair value. We can get fair pricing, which people are happy to take sells. They are also happy to take buys. And once, you know, the market builds liquidity on both sides, manipulates one, manipulates the next. The market moves up and down, and it has to take lows, it has to take liquidity, it has to move into fair pricing to allow both sides of the party to be happy to enter and get involved in the market to generate more liquidity and accumulate more orders, which can then be taken out and harvested to then move and deliver price to its next hard time frame, directional bias, or desired level. Right, guys, so now we're going to be talking about internal range liquidity. So we spoke about what algo structure and inducement are. Next on the agenda is internal range liquidity. So there is a specific sort of times we'd use this to sort of trade the market. One of the characteristics is when there's high volume in the market. So I'm going to draw up a sort of example. So in a situation like this, the market leaves behind a high volumed imbalance, where sort of the nearest order block range would be up here. However, since this order block range doesn't have immediate liquidity, so there's no inducement here, we wouldn't expect price to necessarily come to mitigate this level, since price is likely to react off of the liquidity where the mitigation is sort of close by. So, you know, we wouldn't expect price to reach this level to give us a sell, since there's no sort of immediate liquidity or like any inducement that exists beneath this zone. However, instead, we have this internal range liquidity, where this is our price dealing range. We're dealing with this sort of push bearish in the market. This is our high and this is our low. Within this push down, we have this internal liquidity, where above, you know, we have no liquidity, and below we also have no liquidity. So this is our internal range. Usually this will sit around the sort of premium discount of the price range, so about the 50% level, which is where, you know, you'll sort of be able to get higher probability plays. So, for example, selling at a premium price and buying at a more discount price. So we can see that this internal range liquidity here is around the 50% mark of this range. And obviously, since there's no liquidity close by, we're not expecting the price to come here. So what we can do simply instead is expect price to just play off of this liquidity. So we will see price come and push this liquidity here, begin to react. And once we start to sort of confirm this level with a sort of aggressive, you know, reaction off of it, once it's swept, we can begin to sort of take a sell on price. So this is how you can sort of play price. Well, when algo structure and inducement isn't present, so we're not in a scenario where we have this going on, where price is going to be sort of more sort of magnetized to come to a level like this, you know, where we have price sweep liquidity, a strong rejection candle leaves behind inducement, which immediately gets taken out. You know, grabs liquidity. You know, this is a high probability sort of entry area, but in a scenario where this isn't present, nor is sort of playing the swing level, so playing the algo structure movements off of, say, swing points like this high here, a part of a sort of higher time frame bearish algo structure. The internal range level is sort of gives you a way to get involved. Usually this could be paired with something to make it slightly more high probability. So we may not, in a sense, have an order block, since this order block dealing range is quite high and far away. However, keep an eye out for is potentially breakers or sort of higher time frame imbalance, which, you know, we're going to talk about imbalance and FVG sort of later on in the video. But however, just for an example like this, where we have this price range upwards here, essentially a buy to sell range, even behind this large buy to sell, and also between this range here we have this imbalance. So paired with this internal range liquidity is the fill of this sort of what would be a higher time frame imbalance in price. You could sort of look to pair internal range liquidity with that to sort of give a more you know, sort of more confirmed level to be playing off, in a sense like that. So cool. So for an example, this particular price action here, where we've got this is our bearish price range from this high to this low. It's our sort of 4 hour bearish push. We see prices taking liquidity above this high, so we can sort of say this high is fairly strong. And when we talk in terms of places for sort of price to pull back to continue expanding to the downside, when we sort of up the time frame, we can see we have nice liquidity which exists here. And if you sort of mess with the time frames a little more, you can see that this liquidity could also be seen to be here too. And the actual nearest order block range is here. So as you can see how price is sort of quite far away from this liquidity point, the order block is quite far away. For price to sweep this and also then to continue here is less likely to happen. So we could be interested to sort of more play the actual reaction off of the liquidity. There's nothing like immediate to mitigate, unlike a inducement zone where we have order blocks and sort of liquidity paired together. In this case, price is more likely to react off the liquidity due to this large distance between the liquidity and the order block. So keeping an eye on this level, we can also sort of see if this could be refined in a sense. So this is our liquidity, our free, or you could look at it as a 4-hour major liquidity point. And we can see a tiny volume imbalance here. I'm going to talk about this a bit deeper on later on, but a volume imbalance, which is essentially an FVG, so, or an imbalance in the market. So for example, this is an imbalance in the market. So between the low of this candle here and the high of this candle here, this is an imbalance. This candle's low and this candle's high do not sort of mitigate each other. Whereas if you looked here, for example, this candle's low and this candle's high, which is here. You can see they both mitigate each other. So this is an imbalance. However, a volume imbalance is the same thing. However, no body is in the way. So we have just an imbalance in wicks. So no body of candle. So 1 wick and 2 wick overlap each other. So we have an imbalance here. So we'll keep an eye on that level. And if you see this imbalance is paired perfectly with the actual liquidity point. So that can sort of justify why this could be a strong level. Price comes in to mitigate the level. Subsequently builds up a large amount of liquidity. This is important, and as we've sort of constantly referred throughout the recording, that the market likes to build liquidity on both sides of the market. Intentionally, the market has built the liquidity here, come take out in future, and 2 has built a large amount of equal lows down here. So once price can deliver to this level, grab liquidity here, it can continue down to take liquidity, and that liquidity here will fuel a more bearish push in the market sort of desired direction to the downside, subsequent to the higher time frame trend and analysis, which we're going to talk about top down and so on later on. There you go. Price eventually pushes down and continues. And when you look at this specific price leg here, what do we have here? We have a new bearish range created, or currently, when we look just down below here. Let's go here. So we've got this bearish range created. This high to this low. And what specifically is this range lacking? It lacks sort of any range of candles, it's very high volume. We have this very high volume push down, little price action inside of here, just a large sort of void of liquidity and imbalance within this big push down. So there's no actual liquidity the market would be sort of attracted to take within here. If the market was to push higher, we could potentially look at a zone like this, which we would call an order block with inducement, as this is our level and we have immediate liquidity. Immediate meaning it's very close. So as price takes the liquidity, it mitigates the level at the same time, and we can continue down. This is a very strong liquidity point due to the large injection of capital which got pushed into the market at this time to it cause this push down and sort of break structure here. You know, we can tell that at this level, the majority of smart money traders would be interested at taking sells here. Why? Because they would see this as an attractive POI because it's broken structure. We've had a BOS and it's very high volume. It's very bearish. You know, this is the candle which caused this break of structure. However, we would view this candle as a sort of trap candle or liquidity candle, knowing there's a lot of liquidity resting above this. So we'd be more inclined to look at a POI like this. However, depending on the higher time frame, you know, we may sort of be wanting to see price, you know, potentially take out this level here because apparently, you know, a part of a higher time frame play, price may want to come into this level, potentially fill some imbalance, take this sort of 8-hour or 12-hour, or by the looks of it, maybe a daily swing higher and continue down. However, when we drop down to the price action occurring inside of here, since we have no volume in here, the other sort of closest liquidity point we do have is this internal range high. So this is our internal range liquidity as we discussed. There's no liquidity inside of here. However, we have this internal range of price action which exists here. So this is essentially our build up of liquidity. We could wait for price to take this out and to continue to play down. Just like as we've previously discussed, the market likes to build liquidity on both sides of the market, just like how we built these equals here. You know, you can see prices beautifully engineered more liquidity for the future down here currently. And you know, what could we pair this with? Well, let's hop on the higher time frame. This range, so essentially you could look at this whole higher time frame range is a massive buy to sell range. And this is our internal range of liquidity. So we can see that actually this white gap here is an imbalance, a very, very high time frame imbalance. Very, very high time frame. And as you can see it sort of gives you a hint here, plays out the next candle. This gets filled and continues down. So let's drop down to the lower time frame. There you go. So play this out. So price takes the internal liquidity, comes to fill this range and mitigate this breaker block. We're going to discuss breaker blocks in more depth, but if you're aware of them already, then you can clearly see this is a mitigation of a breaker with a sweep of internal range liquidity. And once this happens, you know, we get a very aggressive reaction of a price, which is what we have for our confirmation for this to hold as a level and to continue down. That price is rejected very aggressively, which is sort of confirming the strength of this level for a sell. And subsequently, sort of price pushes on from there. You may have potentially been able to get involved in here. I'm not sure how long. Okay, cool. So we can see here, you know, we have our grab on liquidity, mitigation of our breaker. We have a very aggressive move in. I'm going to touch on this in more detail later, but essentially an aggressive move into a POI usually will signify an aggressive move coming out of the POI. This particular movement we can call a vector candle. We're going to talk about this later on. We can see price has built liquidity here. Also built trend line liquidity. So, you know, we know liquidity is in our favor for price to continue to deliver. We've taken liquidity and now we're going to trade the market down to target the next potential draw on liquidity. And us, we could be a seller within lower time frame confirmation. See, price has a nice sweep of lower time frame liquidity there. Once we dive into the entry models, we'll be able to see very clearly how we can get involved into trades like this. However, a trade like this would be very much necessary and high probability, a good position, a good way to sort of get positioned in the market to sell down and continue that sort of bearish direction for this particular day and in line with the higher time frame too. So that's a very good example there. So we spoke a decent amount on internal range liquidity there. We're going to cut it here. Next on liquidity, we're going to talk about early liquidity manipulations. So a type of inducement where people get involved in the market too early prior to sort of the POIs that we as algorithmic traders are looking into. So the POIs we're looking at, we want to see traders get manipulated before it hits some levels. We want to witness to see people get taken out before us. And if you can't see the liquidity, then you are the liquidity. So once we cover early liquidations, early liquidity models such as the market maker model, fake breaks of structure, fake chalk, as structure is essentially not significant to determine the market's direction since the market operates around liquidity. So fake breaks of structure, fake changes of character are very important liquidity models. We'll also talk about vector candles, some other sort of characteristics of price action, and we'll go from there. Once we've sort of covered parts on liquidity, we can dive into some IPA or imbalance, inefficient price action, and why sort of imbalance and rebalancing the market is important and how it can be paired with liquidity. We've already touched on imbalance a part here, but we're going to talk on sort of how each candle represents essentially a sort of magnitude of data or orders or a set of transactions, and how the market needs to continually imbalance and rebalance to allow all types of traders with all types of emotion and strategy, both looking to buy and sell, allow all types of traders to be satisfied with getting involved in the market to sort of generate liquidity and then manipulate both sides and sort of continue in the algorithm's desired direction to do the same sort of cycle, but just on the higher time frame. So everything is a fractal. The lower time frame liquidity cycle will fall in line with the higher time frame, and sort of keep going higher and higher until the sort of daily, weekly charts, the more long-term sort of price movements. So we will get onto that, and then we've covered a decent chunk there. We're going to talk on a lot of sort of mitigation areas where price is likely to be drawn to continue down. We've talked about it in terms of liquidity, but in terms of sort of mitigation areas, we're going to talk about mitigation qualities on how price actually taps a certain zone and what it means and what is a sort of rejective way to confirm price movement. Algorithmic candles, talk about some more traps such as structure traps and smart money traps. Talk about some other models and event-driven algorithms, other types of algorithms. Then we're going to hop on to talking about the entry model, going through a bunch of entries, sort of case studies, stuff like that. Going to start talking about some types of trappings in the market. We're going to start off with the most simple one, which is the smart money trap. The smart money trap is essentially a fake supply or demand area in which smart money traders we would expect to be looking to enter either buy or sell positions. Being able to identify these areas it's beneficial to us to know where traders are likely to be getting involved. So we can use this in our analysis to know where we can expect traders to be getting manipulated and where there may be higher amounts of liquidity, to sort of make sure we're positioning ourselves at the most well-priced, high probability areas. So essentially, we're just going to outline a couple of characteristics of a smart money trap. So smart money traps essentially will be levels or order blocks created where the market injects very high volume. And that's the one main characteristic. So a very large sort of high volume injection into the market where underneath the low or above the high in which the order was injected, it's going to store a lot of liquidity. And the next characteristic to one of these zones would be it has no immediate liquidity, or as we call it, inducement. So What does this actually mean? Let's have a look. Let's draw a little diagram. So the market